Hi, this is William Bronchick, and in this video I'd like to discuss the installment land contract, also known as the contract for deed or agreement for deed or bond for title, all basically the same type of animal. What they are is an owner financing tool for buying or selling real estate with seller financing. Now typically this is done with what's called a wrap, which means that there's an underlying loan still in place that you continue to pay on the seller's side. So if there is an existing loan of, let's say, $80,000 and you sell the property on a contract for deed or installment land contract for $100,000, you're wrapping a $100,000 loan around an $80,000 loan. You collect payments from the buyer on a $100,000 note, which can be at a higher interest rate than the underlying $80,000 note to the existing lender. Also at a different amortization timing. There'll be a 30-year probably on the $100,000 and maybe 25 years left on the existing $80,000. So the equity is building faster on the underlying loan than it is on the wraparound loan. Now typically the deed is escrowed in this case, so the seller will sign a warranty deed or grant deed or special warranty, whatever you've negotiated, that will be placed into escrow with an attorney or title company or escrow company who will hold that deed with instructions to give it to the buyer in the event that the buyer tenders the balance of the purchase price. So in that case, if the seller is disappeared or just simply refuses to sell or is in some sort of legal or financial trouble, the buyer can go straight to the escrow agent and get the deed by tendering the balance of the purchase price left on the contract. Now the tricky part becomes when there's an escrow for monthly taxes and insurance. So if the underlying loan has principal, interest, taxes, insurance, PITI, all in the payment, then the buyer will pay principal and interest based on the purchase price, in this case was $100,000 at a different interest rate, a higher one, and then taxes and insurance at the exact same rate that the seller is paying on the underlying loan, and then the buyer collects, the buyer pays the seller collects the taxes and insurance, pays the lender pays the insurance company and the tax collector. It's a little bit tricky, but if you time it right and you keep the math correct, it's not altogether that difficult to achieve. The tricky part of an installment land contract or contract for deed also is when the buyer defaults, how does the seller get the property back? Well, the practical answer is, a simple answer is, you give the buyer cash and you do a cash for keys deal where the buyer gives the property back, gives up possession, and signs a release. That's the simplest way to deal with it. But if the buyer is not willing to do that, then you have to go to court. Now in some states, like for example Illinois and Pennsylvania, it's a very specific process for getting someone out under a contract for deed default, and it's a little harder than an eviction, but not quite as hard as a full-blown foreclosure. In many states, like my state of Colorado and California, for example, there is no particular statute that prescribes what the process is. So you go on an eviction, and then if the buyer, who's the tenant here, objects, then the judge may have to make a decision whether there's enough equity in the deal for the buyer that the seller must foreclose the property, and typically that's a judicial foreclosure. So if you're in a trust deed foreclosure state, it's a little longer process to do a court judicial foreclosure, which of course is going to be problematic for the seller, which again is settle out of court when you can, give cash for keys if you are the seller. The other issue that comes up is, can the buyer deduct the payments he's making on interest to the seller? And the answer is yes, because the IRS considers this a sale from the signing of the contract. Even though title remains in the seller's name down at the county, the IRS does consider this a sale transaction, so the buyer can deduct the interest. If the seller continues to deduct it as a rental property, it's going to get disallowed and denied. And then finally, can the buyer treat this as his own in terms of a refi or a resale? And the issue is yes. The answer is very simple. The buyer just simply lists it for sale. When he has a buyer, he does a closing and at the same time pays off the seller and gets the deed. Same thing with a refinance. If you'd like more information on how to do a contract for deed, a land contract in Colorado, please give us a call at 303-398-7032.